Hey everyone. All right. If you're a UITM diploma student, go ahead and grab your digital planners and, your absolute favorite pastel highlighters. Today, we're decoding FAR210 and MFRS 1116, specifically property, plant, and equipment. But here's the twist. We aren't just looking at buying assets. Nope. In this explainer, we are exploring exactly what happens after the purchase when we get into subsequent costs.
Looking at our study plan today, we're going to cover what subsequent costs actually are, the big differences between capital and revenue expenditure, check out an ultimate summary, and finish up with some essential exam tips.
Section 1, welcome to FAR210. Okay, let's dive into this. On our lovely little checklist today, our absolute main goal is to confidently explain the accounting entries for subsequent costs and exactly how we disclose them in the financial statements. Now listen up, because this is a heavily tested examination point. Examiners literally love to throw a scenario at you and ask, so what do we do with this cost? Well, by the end of this explainer, you're going to know exactly how to answer that without even breaking a sweat.
Section 2. What are subsequent costs?
So think about it. You buy an asset, but what happens a year later, or maybe 5 years down the line? Businesses spend money on their assets long after that initial purchase date. We define subsequent costs as further costs or expenditure incurred over an asset's useful life, strictly after its initial recognition. Basically, it's kind of like the cost of living, but for your business assets.
This brilliantly illustrates the everyday reality of running a business. Subsequent costs can really be anything, from your basic repairs, daily maintenance, a bit of cleaning or repainting, all the way up to replacing major components, paying for a massive inspection, or doing a full-blown building renovation. But here is the accountant's dilemma. Do all of these costs get recorded the exact same way? Spoiler alert, nope, they definitely don't.
Section 3. Capital expenditure.
Okay, so if a cost you incur upgrades an asset beyond its original existing condition, it's what we call a capital expenditure, or CapEx. Think of it like taking a standard car and dropping a powerful, brand new racing engine into it. It significantly enhances the future economic benefits. Because it adds real, tangible value to the asset itself, this cost goes straight into the statement of financial position, the SOFP. You are literally adding this cost to the carrying value of your asset. It's a total level up.
Let's test this with a real-world scenario. Imagine a cute little logistics company called Berhad. They're growing super fast, and suddenly they find themselves needing way more parcel storage.
Here are the exact facts of the case. During the year ended 30 June 20X6, Berhad, who provides courier services, incurred a cost of 60,000 ringgit to renovate its building. Why? Well, to cater for the need to increase storage for mails and parcels. This renovation will clearly provide the company with much more space for its daily operations. Now, the classic exam question will ask you, advise the company on the accounting treatment for this exact renovation cost.
So the crucial point here is figuring out what this 60,000 ringgit actually did. Did it just keep the building from crumbling down? No way! It provided brand new storage space, completely increasing the future economic benefits beyond the building's originally assessed standard of performance. Therefore, this 60,000 is regarded as a capital expenditure. It absolutely must be capitalized as part of the cost of the building in the statement of financial position. Berhad just completely leveled up their building.
Section 4. Revenue expenditure.
Now, if CapEx is a level up, revenue expenditure, or REVEX, is like drinking a health potion in a video game just to survive. Guys, a very common trap in exams is seeing a cost that merely maintains the current level of future economic benefits. If you're just paying to ensure the property, plant, or equipment stays in proper working condition, it absolutely does not get added to the asset's value. Instead, it is excluded from the asset cost and expensed off immediately in the statement of profit or loss, the SOPL.
Let's look at another cute business scenario just to lock this concept in. Meet Laju Courier Berhad. They've got a busy delivery van running all around town every single day.
Let's read through their story together. Laju Courier Berhad purchased a van on 4 February 20X7 to deliver documents and parcels. A couple of months later, on 5 April, they sent that van to the workshop and incurred a routine service and maintenance cost of 2,500 ringgit. The exam asks, explain the accounting treatment for this cost.
So ask yourself, did changing the oil and checking the brake pads make the van go twice as fast as when it was brand new? Did it magically double its carrying capacity? No, since this cost is purely to ensure the van stays in proper working order without actually enhancing any of its performance or functions, it is a revenue expenditure. Therefore, that 2,500 ringgit is simply recognized as an operating expense in the statement of profit or loss. Easy, right?
Section 5. The ultimate summary map. Let's move to and see how this builds.
Here is a crystal clear side-by-side comparison for you. On one side, CapEx. You're enhancing the asset, leveling it up, and capitalizing it right into the SOFP. On the other side, RevEx. You're just maintaining the asset, keeping it healthy, and expensing it in the SOPL. If you can just remember this basic split, you are literally already halfway to scoring an A. Now, what's really interesting about this next bit is how it maps out exactly what FFRS 116 requires you to do. It's basically the perfect cheat sheet. Whenever you face a subsequent cost, just ask yourself, does it significantly enhance future economic benefits? If yes, follow the path to capital expenditure, like improving a machine's capacity. If no, follow the path to revenue expenditure, like your day-to-day servicing. It's just so beautifully organized.
Section 6. Exam tips and closing. All right, here is your foolproof 3-step mental checklist. Step 1. Read the question carefully and hunt for those keywords. Does it say improve capacity, which means enhance, or routine service, which means maintain? Step 2. Once you decide, explicitly state in your written answer whether it's CapEx or RevEx. And Step 3. Tell the examiner exactly where it goes. Capitalized in the statement of financial position or expensed in the statement of profit or loss. If you follow these 3 simple steps, you're going to nail the explanation every single time.
Before we wrap up, I want to leave you with this little thought. Every major asset needs a little maintenance, but only true upgrades build your future. Which one will you invest your study time in today? You got to treat your brain like an asset, guys. Honestly, watching this explainer was definitely a capital expenditure because you just enhanced your future exam performance. Keep reviewing these concepts, stay super positive, and I'll see you in the next lesson.